This is our Forex blog for November 9th, 2012. And like we do most days, we start off with our currency meter. This one uses our new build your own trend that works live only. It uses multiple different time frames. Some of our tools measure direction, some of them measure the intensity of the direction, and I've recently added the daily, weekly, monthly trend. And you can adjust the weights. The weights are always the first number here, and they're 100% of the number here for the daily, weekly, monthly. So the monthly has 4% weight, weekly 13%, and the daily 18%. So basically what we're looking to do is buy the strongest currencies versus the weak, and if the weak currency is on top like the euro is, then we're selling the weak one versus the strong. So we're selling the euro dollar, euro yen today. And the yen was clearly stronger than the dollar. And so it makes it easy. You want to sell the euro dollar, euro yen, pound dollar, pound yen. You want to buy the dollar Swiss, and you want to sell the Swiss yen. So let's bring up the charts and we'll go over. So looking at this chart today, it wasn't initially weak. Here's the hourly moving average. Currencies above the hourly tend to go up, below it they tend to go down. This is the point of control of yesterday. It's the price most actively traded. This is the lower value area, which typically when a currency is underneath the point of control, and especially the lower value area, it's going to go down. So when it went up to that area today and couldn't get above it, basically here's the pivot, which a lot of people use. When it breaks down under there, you want to go short, and you can see it pretty much fell. At this point, it's incredibly weak. During the counter trend move up, there's almost no strength. 15-minute trends extremely down, hourly trends down, daily, weekly, monthly trends just incredibly down. Our signals are giving two sell signals here. If you miss this one here, or if you're looking at the chart and you missed one earlier, you got this nice, beautiful 20-pip move here. You got about a 40-pip move there. And usually underneath the lower containment band, it's going to reverse. You can always draw your fibs off of the last move down. And most of the time, especially near our lower 3.0 band, there's about a 90% chance it's not going to go below that level and stay below that level for more than an hour. So at that green level here, you can really scale into some big positions and do counter trend trades. You know, very quickly. In most days, you're going to get 15 to 30 pips counter trend. And what I typically try to do is when I scale into a big counter trend trade at below the statistical likely low, I'm going to draw my fibs on the entire move down, and I'm going to get out of half of it when it kind of runs out of steam right here, and then usually the second half at the 38% retracement. I'd say 2/3 of them work their way up to the 38% retracement. So if you're trading during the U.S. session and it's down statistically too far and you don't want to take the risk of getting so many times markets have false breakouts at the low, then they rip up. And so if you've traded at all, you know that it's kind of nerve-wracking selling the lows. I prefer to see a nice strong trend, wait for a pullback and get short in a trade like this than one that's just going sideways. That being said, if a currency does go sideways for an hour or two and then it goes lower, it does tend to continue the trend. So you always want to draw, even off of a tiny swing, when it's gone down too far, draw that on there, and usually somewhere between the first and second fib target. Don't get greedy. If you'd be short somewhere around 71, you get out of this with about a 20 pip profit. And we got two counter trend signals here. These only show up with colors when the market's down statistically way too much. So, you know, you can see the earlier counter trend trades are light gray as a possible reversal area, but when the market's gone down an extreme level, they start showing up as colored circles. You can see that's a light gray one because it's a low odds counter trend trade. So let's take a look at the euro dollar. Okay, remember we're looking for sells in this, and some of these buy signals on here are based on the value areas. These are very high probability support resistance areas, and because of that, I do put on buy signals if it meets a certain bar pattern. That being said, you want to override and not take buy patterns when you know, the market's extremely weak like this. These do not in any way use the real-time momentum tools at this point. So you just have to look on this and say, well, it's pretty weak. I'm not gonna buy this. It's a low odds trade. If the market pulled back with something looking like this, not that extreme of weakness, then certainly buy here because usually you're going to make 10 to 25 pips on the bounce off of a key support area like that. But once the support area gets broken, it does, you know, tend to act as resistance. So these sell signals right here in the direction of the trend are phenomenal trades, and you can see it fell from 27.40 all the way down here to 90. Fell 50 pips. You wouldn't have probably made all those 50 pips, but you certainly would have gone short somewhere around 40. And when it came down to the previous day's low right here and went sideways, exit half your trade. So you would have made 20 pips on the first half. And then when the trailing stop got hit, maybe 21, 22 pips on the second half. Now, some patterns that we look for are based on bar patterns and the statistical percentage of currencies trending up or down. Sometimes, patterns like this, you're not going to be able to have a computer find, whereas it's going up, down, up, down, up, down. It shows indecision. There's no real buying here. There's not that much momentum here. And you can just simply draw a trend line, going up there. When it breaks that, it goes short. And when it's down near the lower band, most of the time, draw your fibs off the last wave. And this fib target, look, to the pip is where the end of the move is going to happen. Also, you can increase your odds by, when the market's gone a big percentage, wait for a pullback up near the 38% level. So ignore this trade here because it's a little bit lower odds. I mean, it might continue on down because there is a resistance area here. But if you get short and the market's kind of going sideways, get out of this trade with a 5-6 pip loss. Get short again here and make 10, 15 pips. Short here, make 15 pips, so on. I don't have the Swiss yen up as one of the currencies I leave running, but we'll just bring that up. You saw that the Swiss was very weak, the yen was very strong, and so here's some of the trades. Anytime the market goes sideways, you have a nice little rectangle pattern for 2-3 hours. It's a great low risk, high probability trade. Here you have kind of a pullback trade and a little half-hour sideways rectangle pattern. Those are phenomenal if you find those, especially when the currency is this weak and you go short right there. You draw your fibs off the last wave, and guess where the market stalled. Anytime you can risk 6 or 7 pips, 10 pips, and you have a very good chance of making 20, 25, 30, or even 50 pips, you got to pull the trigger. And this is a perfect example of why we use the currency meter. When one currency's this incredibly weak, and let me move all of them back at the same time. When one currency's clearly this weak, it's the weakest one at that time, and another one's the strongest one, you're going to get some big moves. I mean, it's that simple. Now, as many of the other charts you saw, this is a 5-minute chart. We use range charts. Let's just say 5 pips per bar. You can type in 5R, hit enter. It's going to download tick data and create what I consider a much cleaner chart. And a lot of times when the market's gone down a significant number of pips, you're going to get a 3 to 5 bar pullback. And basically anytime you get a 3-bar pullback where you have 1 bar that goes down, you want to sell it when it goes 1 pip underneath there. So in this case, it never gave you an entry. It had the setup, but it didn't have the entry. And a lot of times you'll get, in one of my signals in the FX signals that you'll see, is you get a 3-bar up move followed by 1 down, and then 2 to 3 up, and then another 1 down. So anytime you see this pattern and it goes up a little bit higher, I'd much rather short up here than right here. It's a much more likely trade, and it's one that at least gives you a good shot of making 10 pips as the market comes back and tests the low. If it goes sideways here and then bounces, you can get out and break even, make 5 or 10 pips, and then if it breaks down, you have a great trade. And again, you know where your profit is. And anytime it makes a lower low, kind of goes sideways like that, just keep lowering your stop. Right here, it's kind of going sideways, lowering your stop. And I'd exit half my trade here. If you want to move your stop above here as it goes sideways, a lot of times currencies that are this weak will go to the 1.618 fib level. So if you want to get out of half your trade here, you never got stopped out on the second half, you get out of your second half here. So you'd be out of half at 34, half at 48. Somewhere in the middle is where your average exit is. Let's just say you exited this at 40. You're short this up here at 80. You made 40 pips. And by using a range chart, whatever the number of pips is, in this case 5, you're risking 5 pips plus 1 or 2 pips padding plus the spread. So your risk is always 10 pips or less. With the tighter stop ones, a lot of times my risk, because once the market goes my way, I'm moving the stop down. A lot of times trades that don't work, I lose 3 or 4 pips. That's it. While still, enjoying the benefit of the trades that work, catching 20, 30, and sometimes 50 pip moves, with only losing 5 to 8 pips when I'm wrong. This is why we use both the range charts and the currency meter to be in the ones most likely to trend.